Warren Buffett recently announced that he has built up a position in Activision as an arbitrage opportunity for the pending sale to Microsoft. But as I said in the video when I covered it, that's not the only arbitrage opportunity that exists in the market today. Twitter's board just announced that they approved Elon Musk's purchase offer at $54.20. And that deal is likely to be closed this year. So the question is, why are the shares of Twitter trading at $49 per share? And how likely is it that this deal could potentially not go through? That's what we're going to cover in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help 1,000 people achieve financial freedom much sooner. And let's dive right into it. So you can see here that as of April 25th, Twitter's board has confirmed that it has entered into a definitive agreement to be acquired by Elon Musk. But note here that Twitter is actually trading under that $54.20 purchase price, despite the fact that it's been a few days since that board approval has been announced, which is interesting to say the least. And there seems to be multiple articles suggesting that this deal may not necessarily go through. And I don't really understand why that speculation exists. I think Elon Musk is pretty serious about acquiring Twitter, but I wanted to dive deep into one of the articles that made the best argument, and that's what we're going to do now. So you can see here, Forbes released an article that basically says exactly what I'm saying. Why hasn't the stock price matched his $54.20 offer? Usually, when an M&A deal is announced, and it's very likely that it'll go through, which in my opinion, this deal is very likely that it will go through. Generally, there's like a 3 or 4% discount, not a 10% discount or an annualized 16% discount, which is the case here. So Forbes goes on to report that there's an NYU professor that said that Musk sees this entire thing as one giant options trade, but has no intention of closing out. That is, actually buying Twitter, with Twitter's $1 billion breakup fee acting as a premium. Okay, so to that, I would say if it's an options trade and the $1 billion is the premium fee that he's paying to enter into an option, I'm assuming he's suggesting that Elon Musk has entered into a call option, then what's the upside if he's paying that $1 billion premium? Is it just to get news articles written about him? This doesn't really make sense, and it suggests that this NYU professor doesn't actually understand what options are. And it looks like someone had a conversation with tech founders and VCs, and the betting odds are around 70% on the completion. So they are high, but low for M&A transactions like this. And I would agree with that. I would have expected the premium to be much less. However, this potentially opens up an opportunity for us. Now, the first question that I would ask is, what is the regulatory risk for stopping this type of transaction? And the article actually does a good job and it goes into it. So you can see here that they do say that the regulators could stop Musk, but it seems that it's very unlikely. So the SEC does not have authority here, which is great because the SEC is not friends with Elon Musk. And the FTC is unlikely to see anything monopolistic about a car manufacturer buying a digital media company. And I think that makes a lot of sense. However, I could see potential issues down the road if Twitter only allowed Tesla to advertise and not the other car manufacturers on Twitter. I could see some favoritism issues there, but Tesla doesn't even advertise, and I don't think they even care if the other auto manufacturers advertise. So I don't think that, in fact, becomes an issue down the road, but it's also a speculative type thing, so I don't think it ever comes up as far as it comes to approving this transaction. Now, the article did go on to mention that there's two other things that could trip up Musk, but they did rightfully say that they're both long shot scenarios. So the first one is that Musk's financing falls through. And they're not saying that the $13 billion of leveraged buyout loans that Twitter would presumably assume, but it's that $12.5 billion in margin loans secured by Elon Musk's Tesla shares that could become an issue. But my point, and you can see here that I wrote it to the right there, is that Elon Musk is worth $264 billion on a quick Google search that I did today. So I doubt that getting a loan for $12.5 billion is going to be an issue. But here's where I think we could actually run into a problem. And I think this is more likely than any of the scenarios that people are suggesting that Elon Musk's financing doesn't go through. And that is that based on Elon's net worth, the news would have to be exponentially bad. So I don't think bad news is the issue, but the real issue is that his species could return back to Earth and take him back to his home planet. And so he wouldn't need to buy Twitter because he's back to wherever he's from. I think that's the highest risk for this financing deal to not go through. In other words, I'm being facetious, and what I'm saying is that I don't think there's any real risk here for this deal to not go through, and I see a real arbitrage opportunity. And then the second scenario that they point out is that Elon Musk makes his tender offers to the shareholders and they reject it. Now, I don't think Elon Musk would have made this offer without understanding who the buyers of the security are and whether or not they would vote to sell this or not. And I think he has a pretty good idea, and his banking advisors probably gave him a pretty good idea that this would get accepted by the current shareholders. Now, just in case this thing doesn't go through, what exactly is the downside? Well, you can see here, my free cash flow per share valuation with a 25 times multiple, which I think is reasonable for Twitter, with the stock-based compensation built in, suggests that the company's worth $41 per share. So it's currently trading at $50 per share. So your downside is not insignificant here. The share price can decline from $49 per share down to $40 per share or even lower. And just for giggles, I wanted to show you what the valuation looks like in Musk's hands. So you can see here that at the same terminal multiple of 25 times earnings, without the share-based compensation, the company is actually worth more to Elon Musk once he adjusts those compensation policies. I think the company is worth approximately $80 per share. And I actually put out a video where I said that he could potentially raise his offer to $69.69. And I was really hoping that that was going to happen, but of course, the board accepted the offer and there was no other competing offer. I actually thought other companies would jump in and make a competing offer and this thing would be in play, but that didn't end up happening. But oh well, that's just how it goes. But the other thing that I wanted to show you guys is that we don't just focus on valuations on these types of companies. I did build out a model on Twitter, which the Patreons do have access to, but we also have a model tracker, which lists all the companies down a list that we're currently tracking. And then we put other metrics aside it. So sort of like qualitative method. And what I wanted to do was show you what Twitter's metrics look like. So you can see here that the intrinsic value is $54 a share, which of course includes that share-based compensation. But I did want to show you that they have zero net debt because the cash on hand is greater than their debt. It is an inflation-resistant platform. They have an exceptionally strong economic moat because they have a consumer monopoly over microblogging. And the company is still continuing to grow out. And so you can see how the Twitter name and the price and the ticker is actually highlighted green. What that green highlight shows on the list that I have for the Patreons is an exceptional company. The only hangup I have for Twitter is that share-based compensation, but the intrinsic value adjusts for that. So if Twitter actually was selling for half of its intrinsic value, I would be very interested in buying the security. However, it doesn't look like that opportunity will ever exist because Musk's taking it private. But the point that I wanted to make was that green highlight for the name of Twitter. There's only around 6 or 7 companies in the whole list of companies that we cover that actually have exceptional status. And so in order for you to take a look and see what other companies fall under that categorization, please consider subscribing to the Patreon at the $5 a month tier. And once again, if you're not interested after the first month, no problem. Message me in the app. Let me know that it's not for you, and I'll fully refund your first month. So it's totally risk-free for you. Kind of like what I think this arbitrage opportunity's risk level is. Now, you can see here that I just did the math for you guys here. So 5420 divided by 4902 gives you that 10.6% return. But of course, because I believe that this deal will get finalized before the end of this year, assuming that it gets finalized on December 31st of this year, you essentially have a 16% annualized return on this stock. And of course, early in this video, I mentioned that Warren Buffett has actually built up an arbitrage position in Activision, and you can get to that video explaining all of those details right here.